Welcome back to the Fault Line Finance. When 1.4 billion people begin buying physical silver at nearly 3 times the historical rate, something fundamental has broken in their confidence. We are definitely not looking at paper futures contracts. We are not looking at exchange-traded funds. We are looking at physical bars. Right now, paper markets claim silver is worth $79. But on the ground in Shanghai, physical metal is trading at $91. That is a 12 to 15% gap that the market cannot close. You are about to see the exact architecture of a global margin call, and why the import ledgers from March of 2026 prove the Western pricing system is mathematically forced to break. This is not a temporary anomaly or a seasonal glitch. This is a generational behavioral shift. For decades, the financial establishment relied on a singular, fragile assumption. They believed that paper obligations could eternally suppress physical realities. But right now, the most powerful manufacturing economy on Earth is consuming raw material at a pace completely divorced from Western spot prices. In the next minutes, we are going to tear apart the actual shipping manifests. We are going to track the massive flow of wealth moving aggressively from west to east. And we will uncover the unspoken reason why domestic investors are abandoning their banking systems to stockpile heavy metal in private, secure safes. When a single nation absorbs over 800 tons in exactly 31 days, the entire global supply chain fractures permanently. The industrial machine demands silver for solar energy panels, while citizens demand it for basic financial survival. They are happily paying a massive premium because they understand a brutal truth that the Western trading terminals violently refuse to acknowledge. The real price is never what a digital screen dictates. The real price is what a desperate buyer is actually willing to pay to physically hold the scarce asset in their own hands. This is the ultimate breaking point. We are watching the inevitable death of a manipulated pricing matrix. The undeniable mathematics behind this massive structural collapse will forever change everything you thought you knew. In March of 2026, China deliberately imported 836 tons of physical silver. Pause and truly consider the sheer magnitude of that specific number. The 10-year historical seasonal average for the exact same month, even when adjusted for expected economic growth, is only 306 tons. What we are witnessing is not a slight beat on expectations. It is not a marginal surge above the standard trendline. That figure represents a near tripling of historical norms, executed in a single calendar month within the borders of the absolute largest manufacturing economy. This incredible absorption of raw material happens precisely when that retail population simultaneously makes a monumental decision. Without any official government directive and without any coordinated media campaign, millions of individuals have independently concluded that silver is worth paying a premium. We must strictly look at the behavioral psychological signal driving this frantic, massive accumulation. Chinese retail investors have helplessly watched their domestic real estate market completely destroy generational wealth for 3 consecutive years. They have seen their domestic equity indices violently underperform. They are acutely aware that their banking system is absorbing debt at an unprecedented scale. These specific everyday investors are not buying heavy silver bars because a technical trading pattern told them to execute a quick trade. They are aggressively buying physical assets because they have fundamentally run out of domestic financial institutions capable of securely protecting their life savings. This is the ultimate behavioral warning signal buried deeply underneath the raw, massive import figures. It completely changes the fundamental nature of what you are actually looking at when you watch the fake paper price across your screen. When a massive population suddenly loses profound faith in the underlying economic system, they instinctively rush toward the oldest store of value. They emphatically demand tangible physical metal that simply cannot be defaulted on or digitally frozen by a corrupt institution. This brings us immediately back to the stark, brutal reality of the current extreme pricing fracture. While Western paper futures exchanges print a fake price of $79, the reality in China commands $91. This massive financial spread is expressed in raw human behavior through deliberate, urgent purchasing decisions made by desperate individuals. The existing global pricing matrix is fundamentally broken today because it completely relies on the fragile illusion of infinite supply. But you simply cannot construct a functioning solar panel with a digital futures contract. You definitely cannot protect your family's financial future with a paper exchange-traded fund that secretly relies on totally empty Western vaults. The true demand is ruthlessly physical, and the actual physical supply is completely vanishing at a truly terrifying speed. In a totally normal, properly functioning global commodity market, a 12 to 15% pricing spread between 2 cities cannot survive for long. The traditional financial arbitrage mechanism is incredibly simple and universally understood by every single institutional trader. You identify the massive pricing gap, execute a purchase on the cheaper Western side, demand physical delivery, and arrange shipping logistics straight to Shanghai. You sell at $91 and pocket a massive $12 per ounce profit. The opportunity quickly disappears as others run the same trade. The gap slams shut, global equilibrium restores, and the broader financial market smoothly moves on. Except right now, this specific historic gap is not closing. It is stubbornly persisting and aggressively widening. And the fundamental reason is the most important macroeconomic lesson the silver market is trying to teach us. On January 1st, 2026, strict new Chinese export restrictions on physical silver officially took full legal effect. These changes created a permanent, severe directional valve. Metal heavily flows into the Chinese market, but it simply does not flow back out. The physical refinery processing capacity between Western vaults and hungry Eastern buyers cannot physically bridge the supply gap on a compressed timeline. By the time the physical arbitrage trade is logistically executable, the volatile market has already moved on. You cannot teleport heavy physical metal. The aggressive physical buyers in China are not short-term paper traders. They are massive industrial solar panel manufacturers. They urgently need physical silver inside their factories this quarter to meet production schedules that cannot be adjusted at short notice. Furthermore, a wave of retail investors have concluded that a physical silver bar in a private safe is a more reliable store of value. These determined buyers cannot be easily outpriced. They will pay $91, $95, or whatever astronomical premium their fear requires. They are aggressively stacking raw physical protection, and they refuse to sell it back to the Western system. The actual registered physical inventory available on Western exchanges is mathematically wildly insufficient to absorb the demand. The Western paper cupboard is dangerously close to empty. It cannot bridge a demand imbalance measured in hundreds of physical tons every month. The pricing gap persists because physical reality and digital paper fiction have violently separated along a massive structural seam. The only resolution left is for the fake digital paper price to move dramatically higher toward the true physical price. The massive industrial solar demand and the deeply rooted retail panic have permanently shattered the old fragile digital pricing matrix. The massive paper illusion is finally completely breaking down right in front of our very own eyes today. This massive historical divergence is aggressively driven by exactly 5 completely distinct structural macroeconomic forces, violently hitting the exact same mathematical coordinate at the exact same time. We are definitely not looking at a random collection of completely isolated daily news events. We are actually witnessing a perfectly synchronized global supply chain breakdown that mathematically guarantees a truly historic price revaluation for the entire precious metal sector. Force number 1. Chinese retail panic buying is currently accelerating at exactly 3 times the established historical seasonal norm. Terrified everyday citizens are desperately converting their rapidly depreciating fiat currency directly into heavy physical silver bars, completely bypassing the heavily manipulated digital exchange traded funds. They fundamentally understand that physical possession is their only true financial defense right now. Force number 2. Massive industrial solar panel manufacturers are frantically front-loading incredibly massive physical silver purchases entirely ahead of officially expiring domestic export tax rebates. They mathematically require hundreds of physical tons of raw material this specific calendar quarter, and they are aggressively hoarding every single physical ounce. Their entire corporate survival strictly depends on acquiring this specific heavy metal. Force number 3. The Chinese Finance Ministry is urgently issuing exactly 85 billion yuan in completely unprecedented 30-year special government bonds. This is mathematically the absolute largest single 30-year debt offering in the entire modern history of the massive nation. When a massive global superpower desperately issues extreme long-duration debt at this scale, it is a glaring financial confession written in raw numbers. They are explicitly signaling intense internal economic pressure and a desperate, urgent need for massive structural liquidity. Force number 4. The absolute total breakdown of commercial shipping lanes straight through the critical Strait of Hormuz. Approximately 90% of heavily discounted energy exports previously flowing smoothly into eastern refineries are now violently disrupted. When you drastically inflate the massive energy costs fundamentally required to physically mine and properly refine raw precious metal ore, you permanently raise the absolute mathematical floor price of the entire physical commodity worldwide. The foundational cost of production is permanently exploding higher. Force number 5. The United States dollar index is structurally breaking definitively below its deeply watched 200-day moving average. When the foundational fiat currency used to exclusively price the global silver market completely fails to hold a major technical support level, the entire Western paper pricing matrix violently loses its fundamental baseline strength. Institutional trading algorithms aggressively sell the weakening currency, instantly supercharging the underlying physical metal demand. These 5 powerful convergence forces are absolutely not temporary daily market volatility. They are a permanent, terrifying structural convergence. The massive retail survival panic The desperate industrial solar accumulation, the historic 30-year sovereign bond issuance, the deeply fractured global energy supply chains, and the undeniably weakening Western fiat currency are all simultaneously compounding into one singular catastrophic event. This incredibly massive, synchronized financial pressure perfectly isolates the heavily manipulated Western paper market. The fake digital derivatives simply cannot absorb a simultaneous 5-point global margin call. The deeply entrenched institutional suppression mechanism is mathematically completely failing right before our very own eyes today. The Western pricing mechanism strictly relies on the incredibly fragile historical assumption that massive digital paper obligations can simply be quietly settled in weak fiat cash if the actual physical supply dramatically tightens. But the incredibly powerful new marginal price setters dominating the Eastern Hemisphere absolutely do not operate on digital leverage ratios. They operate strictly on massive corporate balance sheets and absolutely inflexible industrial manufacturing quotas. If a truly massive industrial complex mathematically requires thousands of heavy raw material inputs to successfully build critical solar infrastructure this specific quarter, you absolutely cannot ever magically solve their massive physical deficit by simply raising artificial margin requirements on a remote digital futures exchange. The fake Western paper price is a deeply manipulated, painfully lagging fiction. The incredibly harsh Eastern physical price is the undeniable, brutal leading truth. When over 800 massive physical tons of heavy raw material completely vanishes into deeply hidden private vaults in a single 31-day month, it permanently and violently narrows the entire global pool of easily accessible supply. The deeply flawed Western financial system falsely believes that they can forever control the heavy physical reality by simply manipulating a digital spreadsheet. But you cannot cover a massive physical solar manufacturing shortage with a freshly printed digital derivative contract. You cannot power a massive nation-growing energy grid with a fake paper promise. The desperately terrified retail investors and the massive corporate industrial buyers strictly demand actual physical delivery. They are aggressively draining the incredibly shallow Western vaults because they fundamentally understand that a total default is now mathematically inevitable. The completely isolated Western financial institutions are desperately attempting to aggressively suppress the deeply broken spot price, while the absolute largest consumer on the entire planet is happily paying a massive premium to drain every single physical ounce available worldwide. The massive gap between $79 on a fake digital screen and $91 in an actual physical vault is the exact architectural blueprint of an absolutely catastrophic, totally undeniable global margin call that will completely destroy the entire legacy pricing system forever today. This is completely not a theoretical future. It is a terrifying, undeniable present transactional reality. The exactly $79.46 quote you currently see bleeding across your digital trading terminal is simply a deeply fraudulent paper claim that the absolute largest physical consumer on the entire planet is currently completely unwilling to honor. The massive, undeniable mathematical distance between exactly 79 digital dollars and exactly 91 physical dollars is the ultimate terminal distance between the deeply corrupt financial system that has historically been and the completely unforgiving physical system that is rapidly becoming. Watch the actual physical import ledgers very closely. The entire massive Western paper illusion is already aggressively shattering. Right in front of our very own eyes, the absolute real mathematical signal is over 800 heavily secured tons, completely vanishing in exactly 31 days. The only true remaining question is absolutely not whether this massive historical pricing gap violently closes. The only question is whether you are physically holding the raw metal when the digital matrix finally mathematically breaks forever. If you want to stay ahead of the next structural shift, make sure you are subscribed. Drop a like if you found value in this data, and share it with someone who needs to see the real numbers.